Matty, in this chat, Spartan and Metals X gets mentioned, and ding, ding, ding for JD and I.
Righto, money miners. Another bloody great yarn delivered by Axis Mining Technology. Have a look at that bloody hat, Trav. How good's the hat? How good's the Champ Ori behind you? The Champ Gyro. Jesus Christ, I wouldn't, if anyone's thinking of any other bloody supplier, give yourself an uppercut, because that Axis Mining Technology is all you need to think about forever.
The gyros and the Oris are actually even better than the hat, and the hat's pretty good.
Trav bought one.
Yeah.
Yeah, just to have in his room.
Yeah.
Right, let's rip in. Mate, we have got a bloody brilliant little fundie chat coming with Matt Griffin from Maple-Brown Abbott. Mate, I've been watching Suits. Can we get your name on the company? It's all about getting your name on the door. Maple-Brown Abbott Griffin. It could be after this.
The business was founded about 40 years ago, and by Mr. Maple-Brown and Mr. Abbott. So I think I've probably got very little to no chance of that happening. So it's a pretty good name in the industry.
Don't give up hope. Don't give up hope, Cobber. Mates, we're ripping you in. So you're bloody. Actually, I won't read the boys' notes about what you do, because that's degrading to them. Boys, lay the land about who this Matty Griffin fella is.
Oh, let's rip straight in. So we've tried to get Matty on the show for a little while, and we've finally managed to make it happen, which we're very pumped about. So Matty, I won't speak too much for him, but he runs the Aussie Small Caps Fund. So a generalist, but quite a bent at the moment, about a quarter of the portfolio in resources, and a lot of the names that we love to chat about. So in honour of you, Matty Michael, I thought we'd start with uranium. So Paladin and Boss Energy are both in the portfolio. And I heard you do an interview maybe 8 or so months ago talking about the supply side narrative that sort of sits behind uranium. We've sort of talked about it quite a bit on the potty, but yeah, keen to hear how you came across picking these two names to start with in the wider world of uranium.
Yeah, that's right. I mean, uranium has been talked about a lot in your show by a lot of smart people. So I guess the difference in where my view is versus what a lot of the rest of the market is, I'm probably less of a super bull on the demand side. I don't see sort of uranium reactors being rolled out like they were in the 70s or 80s. I just think it becomes very hard politically in a lot of Western countries, given these are very expensive builds over 10 to 15 years sort of programs, and you really need to have that industrial base in place. So I think that becomes a bit difficult. What we'll probably see in the Western world is extension of lives continue. And then you supplement that with Chinese, Indian, Middle Eastern rollouts which come online. So I think that leads to some slight growth in uranium demand over the next 10 or 15 years. Noting that uranium demand over the past 30 years has gone pretty much nowhere. I think that probably steps up to maybe 1 or 2% a year. The interesting thing we're starting to hear a bit more of recently is in the US, particularly these capacity upgrades. So the ability for existing reactors to add, say, 5 to 10% on top of existing capacity for pretty low capex. The likes of Duke, Constellation, some of those US producers are starting to do that. So that's probably some incremental positive news for the space. In terms of the stocks, Boss and Paladin is quite simple, actually. Our process is pretty earnings focused. We don't go too far down the value chain in terms of exploration. We want to see production and cash flow within 2 to 3 years. So Boss and Paladin were effectively the only Aussie uranium stocks which fit the bill. We did get quite a lot of comfort on the projects, on the restarts there, spent a lot of time with management and sort of related companies around the space to get comfort on that. But essentially, it's a pretty limited subset of stocks in uranium. They all kind of have hairs on them, so you've got to put up with a few issues in all of them, and I'm sure we'll talk about some of those. But that was a decision driving Boss and Paladin into the fund over the past couple of years.
Well, we'll start on Paladin. Start on Paladin then. As an equity holder, what was your, I guess, initial reaction to the fission merger? Yeah,
it's an interesting one. Look, it's long dated, so that project's probably only going to be in production post 2030. Taking a view on the project, it's a difficult part of the world. It's remote. There's obviously a lot of permitting challenges to get through, and there's issues around kind of freezing, the ground there to get the production ramping up. So it's not without challenges. Having said that, it is a very high quality project, high quality deposit. Should be very low cost. reasonable sized producer. I can see value in excess of where Paladin's paid, so I think they've bought it quite well, and at a pretty depressed time in the short term cycle of uranium. I don't think taking pounds out of the market or consolidating supply is a bad thing either. I think that can only sort of lead to better things on pricing dynamics. So reasonably positive overall, noting that it is quite long dated. I think Paladin just becomes kind of the growth uranium option for many investors. It's big. It's got hundreds of millions of pounds. There's plenty of optionality there. So I think if and when we start to see the spot price tick back up, Paladin probably sort of attracts some of the bigger global investors to that growth pipeline.
It was looking at the flyover thing of the fission project. It looked bloody easy. It was all green and everything. They don't put all the snow on the animation of what the project looks like there, and it looks like that's pretty easy to get to. But from what I've heard, those projects are so remote, and the logistical challenge of developing them is something not to be underestimated. But then you look at the fission project being right next door to Nexgen, so you got two projects very close in a very remote area. It just makes obviously so much logical sense that there'll be one standalone operation there instead of two. How do you see all that possibly tying up? Crystal ball time, mate.
No, good point. And I mean, the remoteness and the challenges around location, weather, all that sort of stuff. When you look at the project, it's a 350,000 tonne per annum mill, and it's going to cost over $1 billion at the moment to build. So that just kind of goes to the challenges of how expensive and how difficult it's going to be. Absolutely agree with your point. Right next to Nexgen, definitely makes sense. Should be a lot of synergies in finding those operations. Having said that, covering the mining space for a long time, there's been a lot of sensible acquisitions over time, things that make sense, but it depends on the people at the time, depends on where the egos get involved, board type stoushes, that kind of thing. So on paper makes sense, but let's see how it plays out. There's still kind of a long time to go in those projects.
Matt, the warts on Boss is obviously what I want to talk about. I listened to there was a potty you must have done years ago. I think it was 2019 or something. But you were talking about the importance of founder-led businesses. You spoke about at the time, selling all of your PA and putting it all in the fund, and that's alignment to you. Is you're fully aligned with. Now, and you know where I'm going with this line of commentary, don't you?
Yeah.
So how do you there's only I get there's only a limited number of places you can allocate your capital given what you articulated with uranium, but when you see the MD and two other directors selling 70+% of their shareholding in Boss, what's the read through on the alignment kind of factor for you?
Yeah, look, I completely get the point on Boss. Management and board selling big stakes in companies is always a red flag, and it's never a good thing. So would I prefer to see them sell 20 or 30% of their holding and do that over a stage period? Absolutely. So I think that's definitely an issue, and that's created some problems. I think it's worth just remembering where Boss has been on the journey. Duncan joined that company in early 2017. He put 100 grand of his own money in at the start at 4 cents. So that's a pretty good indication of just sort of the value that's been created over the time that he's been there, over that 7 or 8 years. He took over a project which obviously didn't work under Uranium 1, had a lot of issues around the drilling side, the flows, the plant. So all those problems have been solved over time. I certainly don't begrudge him taking money off the table, especially considering he did put more in and during COVID and in a placement post that. As you say, the quantum's problematic, but it's done now, so we've kind of got to move on and assess where we're at. I think the update they put out the other day, along with the guidance for the next 3 years, is kind of exactly in line with the ramp-up profile they'd previously communicated to the market. There's obviously a month or two delay at the start there, which is not unusual in a lot of these commissioning projects, but all the early signs seem pretty positive. I was up on site probably 6 or 9 months ago, got a pretty good read-through about what they're doing differently, how that ramp-up profile looks. So I'm fairly comfortable with that, noting that it is still quite early on, and these ISR mines do take 2 to 3 years to ramp up fully. So it's not without risk, but I think a lot of those boxes have been ticked now. The other thing I'd probably say in defence, and at the time that Duncan and the board sold, the price was $5.50 or $6. So there was a lot priced in at that point. We were assuming uranium prices over $100 kind of forever. clear ramp up in commissioning. We had sell side numbers, which still were assuming some sales in FY24 and 25, looking a bit too optimistic. So to be honest, we were actually trimming our position at the same time. So selling when price is expensive is kind of what you do. And we're looking at it now saying, well, the share price has retraced 35%. There's been a pretty good start to commissioning. Not even still a long way to go there, but I actually think it's something worth another look for people who missed the story the first time, and something that we've added a little bit to the position in recent weeks as well.
So if they're down 35% now, like, because the whole thing about these uranium equities was trying to back solve, you know, the free cash flow they're going to generate to what they're being valued at the moment, and it just didn't seem it was adding up. And especially considering Boss isn't like a multi-decade operation, it does have a it's not a 20-year life, but is coming back down to where it is now, sub $4. Is it starting to maybe make a bit more sense about what they're going to make and what it's been valued?
Yeah, definitely. Yeah, I think the valuation is a lot more reasonable now. Look, longer term, I do think there's upside from Gould's Dam and Jansen's, some of the other ground they've got around Honeymoon, which will either be tied in or have a separate plant. So I think that probably does provide you a 20-year view. And I know there's a lot more work going on in terms of drilling and studies out there at the moment. So that hopefully will eventuate over the next 6 to 12 months. So you get a bit more visibility on that growing production profile. But yeah, going back to the point, I definitely think there's more value now. The cash flows over the next couple of years will take some time to ramp up. But when you're looking at sort of 2 to 3 years' time when they're at full production, you're probably getting to a kind of 10% free cash flow yield, which is not too bad. Uranium's interesting though. I mean, there is a very limited set of uranium companies to invest in. So we're positive on the uranium price. I do think we're kind of 1 or 2 years into what will be a 5 to 7 year cycle. Where can you play that is essentially some of the majors like Cameco and Kazatomprom, which have got a lot of that contracted. So there's not a huge amount of spot price leverage. Boss has got a lot of spot price leverage. Paladin's got a fair bit as well. And I think just trying to pin certain valuations on these things can be a bit troublesome, given they will just trade with spot price sentiment. We've had a fairly weak 6 months in uranium spot price. The feedback I've got is that people have been more focused on securing enrichment capacity, and that's led to sort of weakness in contracting over the first half of the year. I think that'll flow through into better contracting in the second half. I do think we'll see a step up in spot price. And it's probably important to note that the actual term price has kept ticking up. We're at about $80 a pound now on the term price, with ceilings up, you know, 125, 130. So again, that just probably goes to the underlying strength of that market and just the dynamics we see over the next few years. Hard to pin a valuation of these things. I think once the spot price starts to recover, when that happens, I think a lot of these things are forgiven and the equities start to recover in line with that.
The obvious stock that's, you know, not in your portfolio there is Nexgen, and is that just a function of the fact that you have to own something that you think will have earnings 2 years from now?
Yeah, pretty much. I mean, Nexgen's interesting. Look, it's one we could own if we wanted to. Generally, on the earnings certainty side, we want stuff in production or profitability within 2 to 3 years. I think when it's a project as high quality and as obvious as Nexgen that it will be in production, I'm more happy to take that risk on getting involved a bit earlier. That's kind of an interesting one. I mean, we're sort of at a bit of a stage now where they need to progress some permitting. What happens with CapEx estimates? How does the funding come through? There's some milestones they can tick off over the next 6 to 12 months, which could re-rate that project. But I do think over the next few years, that's just going to be more driven by the uranium price than anything. The broad parameters are kind of set. There's not too much they can do in terms of construction issues or massive delays in terms of that project that could derail it over the short term. So again, I think that just comes back to being driven by where the spot price heads in the next 12 months.
JD, Matt, out of respect, I'll stop talking about uranium. I could keep going, but I'll let you keep things moving.
I was just keen to hear your thoughts, Matt. Obviously, you're an Aussie fund going at ASX stocks, but we've mentioned a few names with Canadian relations. I just wanted to hear if you had any thoughts on the news we've heard about, you know, them clamping down on M&A, and just how you see Canada as a jurisdiction for mining projects. Yeah,
it's an interesting one. I saw the headlines. I haven't read in a huge amount of detail what's happened there, but look, I think basically what will happen is that if Canada cracks down on M&A, you know, the capital flow elsewhere, the companies are listed on other exchanges. I know one of the things the ASX has been doing to arrest the sort of decline in IPOs and the amount of companies leaving the board through M&A is actually incentivising some of these companies to dual list. So we've seen the likes of Metals Acquisition, Capstone. It sounds like that process of dual listing is becoming a lot easier on the ASX. So I do think we see probably more companies gravitate towards Australia as an investment destination. I think it probably just hurts Canadian stock exchanges, to be honest. The money will flow somewhere, and if Canada is going to be too restrictive in terms of who can take over companies and that sort of thing, the companies will just move to other exchanges, is my view.
Nexgen dual listed as well. It's amazing when you see these companies on other exchanges dual list on the ASX. Because the ASX is obviously like they're incentivized to get more ASX listings. That's how ASX reaches their KPIs. But they will offer all of these like pretty insane waivers to these, Canadian listed companies, et cetera, to dual list. And that means that they don't have to comply with the same, like there are certain listing rules that they'll be exempt from. It's interesting. They get to play by a different set of rules when you get the dual listing on the ASX, because ASX just wants you over here because you're a big company. Come.
Pretty much, yeah. And that's the issue. I mean, there's just been a complete lack of new companies listing on the ASX. A lot of, especially in the industrial space, we've seen the whole building material space pretty much get hollowed out through M&A lately. So the ASX wants to get listing numbers up. I think their approach has been, look, if you've good enough to list in Canada or the US or New Zealand, then you should be good enough for the ASX. So it's always interesting, though, seeing just the differences in reporting requirements, the differences in some of the waves you talk about. So you've got to be comfortable with that sort of stuff before you can actually invest in those companies.
One of those ones that is now listed here is Metals Acquisition Corp that you've mentioned. You're a holder coming from the New York Stock Exchange, where they've got another listing, and they were super, super well received when they came on. I think they upped the IPO amount of money that they took in twice. And then they had a bit of a sort of bumpy start, obviously getting a lot of love on the copper thematic side of things. But the last quarter on a production side of things was, a bit how you're going. How do you see the company going forward? Obviously a high pedigree sort of management team with an asset that a lot of people have taken a liking to. What's your sort of view of it?
Yeah, we're pretty positive on the name. Look, I've got no great insights into where copper's heading. We're a team of three sitting in Sydney, so for us to have a hugely differentiated view on copper is pretty difficult, but we're pretty comfortable with the commodity and the drivers there. So finding copper exposure has been quite difficult on the ASX, especially ones that screen value, which I think Metals Acquisition does. We've done a fair bit of work there around kind of the structure, the turnaround. There is complexity in that story. And I think that's probably led to the opportunity and where the valuation is versus some other copper peers. In terms of the quarterly production numbers, look, it is going to be lumpy. It is a pretty high-grade, low-volume mine going through a turnaround. So no surprise they're going to have good quarters and bad quarters based on when high-grade stopes come into the mine and different other things. I think there's quite a lot of work that's gone into that 3-year production ramp-up they show on the plan. I would back Mick and the team to turn around. I mean, hearing about how Glencore operated that mine, some of the challenges there, I think getting a good operator in really does provide a lot of opportunity, although it's not a quick fix. I mean, clearly the constraint there is ventilation. That's going to take a couple of years to get rolled out fully through the mine, and that's really where you start to see those productivity gains. There's some other interesting upside angles there. I mean, you've got a zinc resource, you've got a bunch of remnant areas which kind of aren't in the reserve or the mine plan. You've got a very underutilised mill, which probably needs a little bit of capex to get back to those levels. But I think once the team gets in a good operating rhythm, starts to deliver some pretty consistent quarters, that's when we can start to think about kind of what's next. I know the market's concerned as well about potential acquisitions. It is called Metals Acquisition Corp. I don't think they're going to blow their brains out on doing anything too stupid. I think it would have to be pretty value accretive. You've got quite an aligned and incentivised management team there. So I think the quick wins for them are really fixing up CSA. Maybe there's some other things they can do in the region, which are kind of smaller deals which add a bit of value. But I think to do something bigger and a step out would have to be quite compelling for them at this stage.
It's so hard to find the quality. Like, they are very deep, but it's the quality of that ore body is just miles ahead of everything else. Like finding quality copper, unless someone finds a friggin' bloody VMS deposit at 5% in the next friggin' month, there's nothing just jumping out. It's like, do you look at it and think, would you do M&A just for the sake of it, or is it going to be more detrimental?
Yep, good point. And I guess that's the problem with having a high quality asset that's kind of better than anything else out there. You're always going to be diluting. We've probably seen that with Deterra lately. Deterra is quite an interesting one. One of the best, probably the best royalty stream in the world. But anything you're going to buy is going to be dilutive to that. It was similar with Sandfire years ago. Sandfire had one of the best copper assets in terms of grade and costs, and anything they were going to buy was going to be dilutive. So that led to some indigestion there. So yeah, it's going to have to be something pretty good for Mac to buy, I think. The quality angle is interesting. I mean, definitely the quality of these ore bodies is decreasing, and you've got to make trade-offs between how low you're willing to go on the quality side compared to where sort of valuation is. We
love to spitball, what's Mac going to buy? And there's so many players in that Cobar region. And when you look at the lay of the land of the juniors out there, where can you sort of see the most value accretive synergies at the moment?
Yeah, in the Cobar region, I mean, the obvious ones, Aurelia, I'd find it hard to see Mac buying Aurelia. I think there's probably some asset type deals to do. The Great Cobar asset that Aurelia have would fit quite nicely with Mac, I think. Potentially some of the zinc that Mac has could go through Aurelia's peak mill. So I think there's probably more synergies in terms of how those assets come together and which mills they go through rather than needing to do full kind of M&A. Other than that, I mean, there's some interesting exploration ground. I think having a mill that operates well in that region will provide power over time. It's just going to be a matter of, I think, Metals Acquisition needs to sort out how big CSA can get. It's still quite early in the journey there of cutting resources and reserves and just planning out probably 5 to 7 years, because they may well have enough of the raw material to fill the mill without needing to get anyone else's product through there.
But it's just the life risk there in terms of how deep can you go and keep the ground from bloody squeezing in, like keep extending the ventilation to that's it's very similar to Gwalia. Like everything just slows down so much at friggin' 1,800 metres deep. Well, the future of DSI is looking great with bloody everything getting deeper in the Cobar region, isn't there? Bloody any M&A, more DSI bolts. The deeper CSA goes, more DSI bolts, more DSI bolts per metre, per depth. So exponential bloody growth for DSI coming.
It's Matty, amazing. When I was setting up the call with Matt Griffin, I was speaking with him, and he said he's been on a site visit out to the Cobar there, and he just knew, sort of bakes it into his model. Once they get the DSI orders in, they come and fill this place up, and they'll be going 3, 4, 5 kilometres deep there. Not a problem. Rest assured.
Won't they what, JD? Mate, the DSI bloody portal sets will be just getting that's how they'll be holding up CSA. So look, my query's about CSA's depth and the finite life there. Not a problem, because DSI are making it happen.
Holds the mind together, and it holds the model together.
Oh,
go Derek Hurd.
It's like, but it's offset by the grade.
No, it's a great point. Yeah, and look, we own Genesis as well, which owns Gwalia. I went out to Gwalia last year, went all the way down 1,800 metres down the decline to the bottom.
Yeah.
And you can see the challenges that depth has. We got stuck behind a broken down truck coming up. So, but again, that's the opportunity for these guys who, Mick at Metals Acquisition, Rally at Genesis, the guys who good operators, get good people in there. That's the opportunity to turn around some of these deep mines which have challenges. I think with Gwalia as well, just taking the pressure off Gwalia in terms of the tons, bringing Ulysses in, I think that's kind of a game changer there. So there's always risks with deep mines. You can have seismic events, you could have other issues happen at any time. But again, that's just part of the risk involved in investing in resources. And we certainly take all those risks into account up front, and that really drives position sizing. So high-risk companies get a low weight in the fund for that reason, and it means that if something does go wrong or blow up, hopefully it doesn't wipe out our returns.
I just came up with a deal idea, JD and Matty, and it's I'd love to bounce it off you, Matt. So obviously IGO were they weren't really the underbidders on Mac, but the deal blew up because it got leaked. But it was IGO were there and thereabouts in the process when Glencore was selling Mac. And now more than back then, IGO is desperate for copper. They need They need a bloody, they want copper. They've got an identity crisis. What if IGO acquired Mac today and Mick McMullen runs the vehicle? Which, is that?
Oh, that's not too bad, Trav.
I'll put one reason why it wouldn't happen, because Ivan just got into the hot seat 6 months ago.
Yeah,
there's a couple soft issues there. Although a big payout would make a few problems go away.
That's all right. Take the hard drive on the way out.
I was about to say that.
Matt, what are your thoughts on that one? Oh, look, interesting one. I'd probably say where IGO is at the moment, Nova obviously operates pretty well. I don't think there's too many improvements to be made there. With the Greenbushes JV, they're sort of non-operators there, so it would be hard for someone else to come in and make huge operational improvements to IGO's assets, I would have thought. Given IGO's in the large cap index, it sort of fell out of a universe a few years ago. It's not as close to it anymore, but interesting, but unlikely, I would say.
We can always dream, Trav. Hey, Matty, we've got a thing. As long as it's recorded, we've got it in case it happens.
Yeah.
So, mate, probably a good segue into Genesis that you mentioned before. Another one of your holdings. They're and probably in line with the Silver Lake Red mergers gone through. Genesis, big future growth coming from Tower Hill, and it looks like they've got a plan to change that location of that terminal for the terminus for that railway instead of diverting it. But the big question is, for that growth of that company, is the consolidation with Red 5. What horizon are you putting on that? Because that will be a game changer for that region, and I'm sure it's going to happen eventually.
Yeah, it could do. I don't think it's near term. I actually think Genesis has got more than enough on their plate organically that they don't really need to look at M&A. If you look at that 5-year growth plan, there's a lot to execute on. Tower Hill approvals is really the key one, and I think that's, to be honest, that's probably where Rally's spending like 70% of his time just trying to get those approvals done, because that is such a big value driver. My sense is that it's probably more likely you'll see bolt-on M&A around the Dacian Mill, Mount Morgans, around that area. And then you can potentially look at maybe a new mill at Gwalia just to put the Tower Hill stuff through, given that's right there. So longer term, I'd expect maybe a new build at Gwalia, potentially a Red 5 takeover if there's a bit of value there and you can see the synergies. And then bolting on some of the other deposits around Laverton to feed through that mill. Look, there's a lot going on there. I think the thesis really is that it's not cheap on this year's earnings or next year's earnings, but it's one of the few Aussie gold companies with a good growth profile, which is severely lacking in the space. Certainly back the team there. We were with them on the journey through the Saracen days. I know how conservative they are in setting numbers. There's just always some level of upside and some things they're not telling the market there that always tend to just lead to small beats and small upgrades. And the execution has been second to none over their period in the market. So that makes Genesis a really attractive proposition for us without needing to look at any sort of M&A. I think they can easily get to 400,000 ounces, potentially 500 on what they've got. And you look at the resource base there, there's 15 million ounces in resource across that group, with I think only 3 in reserves. So a high gold price, a bit more work on some of these other deposits, and you could see a lot of that kind of shift from resource to reserve and really build out that production profile.
Sounds like they need bloody K-drill to convert that bloody 13 million ounces of resource into reserves. A bit more peppering needed. Get it up to indicated and measured. Get it into reserves. The future of Genesis is hanging by a thread for K-drill to take. I can feel it.
Mate, get some indicated ounces, get some more inferred ounces while you're there, get some measured ounces.
Mate, they might have 20 million ounces by the end of it.
Get some uncategorized ounces in the mine plan. Actually, don't do that. That's
it's not just Genesis either, fellas. You think about all those explorers, and as soon as Matt Griffin's, he's talking about them, all of them, I can already feel the phone buzzing for Ryan O'Sullivan. They all want to get taken out. They want Genesis to take them out. All they need to do is pepper in a few more holes, and who else would you rather have do it than bloody K-drill?
Yeah, and look, Ryan's been given a lot of love, but Drew Harvey's email is in the show notes. Give Drew some love as well, and he'll introduce you to the team, and you will get ounces. That's all you need to know. And more ounces, JD, more of a takeover premium.
you don't have to worry about Drew not going hard at the footy, mate.
He goes real hard at the footy. Go Australia. But how would that merger, like that combination, come together? Because now to be, Red Five's a bigger market cap than Genesis, so that obviously creates some who's getting the premium.
Yeah, no, exactly. And there's obviously a lot of other stuff in Red now with the Silver Lake assets and Sugar Zone in Canada. So I think it's just too difficult in the near term. I wouldn't probably expect that to really happen. I think Genesis has got more than enough to execute on over the next sort of 3 or 4 years in their own plate. I would just think, if you look through the history of Saracen and Northern Star, the big M&A there was kind of at very attractive prices, distressed assets coming out of large companies. There were kind of no-brainers there rather than having to really pay up for assets. So I probably wouldn't expect anything huge out of Genesis on the M&A front in the near term.
But do you think they would do any mill upgrade or mill expansion at Gwalia, knowing that the most optimum case is getting that King of the Hills massive new mill and possibly expanding that a bit?
Could do. I mean, it comes back to my earlier comment that there's a lot of things that make sense in resources, and a lot of the time these obvious deals don't happen because of personalities, egos, valuations. So you get these situations where 2 brand new mills are built right next to each other when one could have done, and that's just the way it is. But it's going to come down to, I guess, the relative share prices of people at the time, whether any of that happens or not.
Yeah, right. What do you think about the M&A? So we're talking, when you're talking about hoovering up some around the Laverton and that side of things, like just literally pinching the few of the juniors to get a bit of extra feed, and they're going to just sort of, what would you say, a bit like Ramelius historically before the Spartan thing, like just taking little dribs and drabs instead of big deals.
I think that's probably it. I mean, the one reasonable sized one there is Magnetic, which looks like a very good deposit, and that could go through probably either the Granny Smith mill or through the Dacian mill, unless they go alone. So otherwise, there are a number of other small junior sort of operators around there. The other potential is that West Australia Underground could be revisited, and that could be more economic now given gold price and a different operator. So there's just lots of optionality in Genesis. I just think the 5-year plan they've laid out is probably unlikely to end up in that form in 5 years. I think it's a good base case, but there's a lot of optionality around other things, how they could, reroute different deposits through different mills. And I think any of that's just pure upside to where the company's trading today.
Then if you kind of look elsewhere in the ASX gold landscape, if there was ever a producer that it's just been easy for investors to set and forget over the last 8 years, it's been Perseus. They've created tremendous value there, and it makes a lot more cash than other golds when you look across the board. What's the investment case for holding it now after a period of great operational delivery?
Yeah, I mean, you say Perseus is set and forget. I mean, it does operate in interesting parts of Africa, and there's always things going on in different parts of Africa that make it.
There's lots of risk there. That is true, but the operational delivery's been great. Yeah. Yeah,
no, well, that's the thing. And actually, to give credit to the whole African sector, the operational delivery has been far better out of African producers than it has out of the Aussies over the last 5-10 years. You look at what WAF's been able to do, what Resolute's been able to do recently in Perseus. They've navigated very tough economic times, a very tough country risk over there to deliver great results. And I think that's really shone through in the cash they've generated. Whereas you look at the Aussie producers, and Aussie gold price has been going up, the costs have been kind of going up in line with that. So there hasn't been that operating leverage come through. Perseus today, I think the OreCorp deal was very smart, done at a very good time without much of a premium being paid. That stock would probably be a lot higher today if it had kept trading. So I think they've done very well there. That adds to the growth profile. I think you'll see some life extensions out of Edikan, out of Yaouré, even Sisingri maybe. And then once you layer in Nyanzaga on top, you're up to kind of 700,000, 750,000 ounces for a few years. And it can be funded purely through cash. The other benefit is that OreCorp, being a kind of underfunded junior, had to go optimise around open pit underground. A bit of a challenge in terms of how they were going to mine that, whereas Perseus can probably come in, spend a bit more capex, take a big open pit, get get more ounces through and probably at a low cost base. So I think economically it makes a lot of sense to them as well. And the relationship with the Tanzania government seems to be pretty good too. Trades
at 3.4 times next 12-month EBITDA, which is, and has better margin preservation than the ASX, also than the WA-based goldies who command a higher multiple. But that's just the way that the market is willing to, reward the geopolitical, risk aversion.
Matt, have you looked in West Africa? Obviously, you've picked Perseus there, but Resolute's been a really strong performer of late, and West African also, in comparison with Perseus, has a sort of great operational track record since they brought Sanbrado online a few years ago. Have you looked into them, and is one of the reasons that they have a bit of a spread across a couple of West African geographies the winner there, or are there other sort of reasons why?
Yeah, we have owned WAF through the Sanbrado construction and ramp up, did very well out of that stock. Resolute is one that I've been following for 15 years without owning, and then eventually pulled the trigger probably 18 months ago. Didn't own it up until pretty recently, so it was a pretty good contributor for us. I definitely think Perseus having the spread across different African countries does help, especially when you look at the political landscape, the influence of Russia, some of the other activities going on in Burkina Faso and Mali does see those countries be a bit challenged. I think people have the perception that the African risk is probably greater than it actually is. When you look through all the coups that happen, all the terrorist events in these countries, gold is kind of the one industry that just keeps going. The government doesn't really nationalise assets unless there's an ownership dispute. So if you've got clear ownership over an operating asset, that's stuck through, and production's been pretty consistent. So I'm probably less worried about the political side, but it doesn't help when you've got Mali building their own gold refineries and forcing everyone to sell to them. And what does that mean in terms of price? Burkina's raised royalty rates, harder to get money out of the country there. So certainly Resolute and WAF have done very well, still look fairly cheap, but Perseus is the pick just because they've got the spread. I think they're in more stable environments over there, and they've got the growth lever of Nyanzaga coming through, which I think adds a lot of value.
And then there's the two premier undeveloped projects, Spartan and De Grey, and you own both of them. They're obviously pretty different projects in almost every single way. What's the kind of the rationale for holding both?
Yeah, look, to be honest, it's stock specific on both of them. So again, with gold, we're pretty positive on the gold outlook, but the reason we own these 4 gold stocks is because we like the stocks, we like the management teams. We think there's plenty of upside as long as gold price kind of holds in line with where consensus is. So Spartan, we got involved in the raising 40 cents last year. So we did miss, the first 300% of the run-up, but that's typical for us. We want to see some runs on the board. We want to see things get a bit de-risked before we get involved. I do see substantial upside to where that is. I was up on site there a couple of weeks ago. What's being underappreciated, I think, is just the value of the infrastructure in place there. It's effectively a new mine that only operated for a few years, ready to be restarted with permits, everything in place. They just need to get some trucks and work out what they are going to do with the mill. In terms of the exploration side, I think it's going to be important to see what the indicated number is at Never Never out of this upcoming resource. That really then drives thinking around how big production could be, how long the mine life is. You layer in Pepper on top of that, and you can start to model up really attractive cash flows for at least a sort of 6-7 year period. So I still think there's more to go there. And the other thing with that story is that exploration decline will be a game changer for them. Once you're underground there, they can drill twice as fast, half the cost. So delineating those ore bodies will be a lot quicker and a lot easier. The exploration decline effectively ends in ore at Never Never. So you've done your whole development, you can just start mining. And it then allows a bit of focus on some more regional targets as well. And just given how that old Gascoigne, they just completely sort of misread the geology on that site. You'd have to think there's potentially more repeats of the structure and potentially more exploration can be done there. So still very attracted to Spartan. I think Simon's done an incredible job. The mentality he's got running that company, the team he's built underneath him, really part of that Northern Star school. So he's certainly been the right man there. De Grey is an interesting one. We took part pretty recently in the last placement at $1.10. The view there on De Grey is that, look, that funding was probably a bit of a shock to the market. I think people probably expected the equity raise to be done after the debt had been locked away. That was maybe the opportunity for us coming in, being new to the register, just seeing that the funding now is effectively in place, provided they can convert this debt, which sounds quite likely. They'll have about a $200 to $300 million buffer on top. So there's not too many concerns about another raise or anything for the next couple of years until they start to really get towards commissioning. But that stock really has just been left behind in the gold rally. You've got a 10 million ounce resource, 550,000 ounces a year production, completely unhedged, and the stock's gone nowhere. So to us, that is a tier one asset. I think you're obviously in the wrong part of the Lassonde curve now, where you're financing and building. To counter that, you still do have some news flow to come out on studies around Withnell in terms of that maybe adding another 100, 150,000 ounces. So by the time you get that through, you're at, call it 700,000 ounces a year for at least 6 years. That does become a very attractive asset, especially in a gold space where the majors and mid-tiers have, stable production assets, complete lack of growth, complete lack of new projects that have been built, and very good cash flows coming through. So it just seems like quite an obvious M&A target to me over the next couple of years.
No, because it's bloody risky if they try to build a 10 million tonne operation with a brand new company, brand new team. That's a fucking recipe for disaster, I reckon.
Absolutely. No, fully agree. I mean, I do think there's been a huge amount of detail and a lot of work that's gone into those studies. There's good people they've got on board who've built big projects in the past who can manage that well. But look, agree, like the history of the gold space over the last 4 or 5 years in terms of bringing on new projects has been pretty tough. Building something that size with a POX plant up in the Pilbara is not going to be easy. So whether we own it into commissioning in 2 to 3 years' time, I'm not so sure about, but I can see some catalysts in the short term. I can see a share price that's really like the gold price, and I can see some potential M&A appeal out there in a gold market that I think we're going to see a lot more M&A over the next year or two.
Who do you reckon's going to have a look at it?
There's 2 that stand out for me. The first one is Agnico. They've been up at conferences in the past saying there's kind of 3 premium mining destinations in the world, of which one is WA, and they don't have anything in WA. I believe they operate a POX plant or 2 in their portfolio as well, so they've got experience there. So I wouldn't be surprised if they were interested. And the other one is Goldfields through kind of Gold Road. They own half of Gruyere already. They own a stake in Gold Road. I understand there's been some management changes in Goldfields internationally and in Australia, and they might have more of a growth mindset. So rolling up Gold Road and De Grey would potentially make sense at some point as well there.
I don't think they've got the POX experience, but do they, at any of their operations?
No, but I mean, you'd hope you can bring in people to kind of take care of that. I kind of look at SSR, the older Lassa, when they started up Chirpla, the sulfide plant there, and I don't think they had any POX experience before, but that kind of commissioned really well and produced what it should. So I think if you've got the right people there, it's known technology. It's not as much of a black box as people may think.
Nothing that Nathan Stoitis can't fix. Bloody God, love him. Back just to finish off on Spartan, when you talked about the value of the infrastructure there, and that probably bodes well for the Spartan investment if they don't get taken over, but it's looking like more than not that Ramelius is going to get them eventually. Well, they've got the foot on them at the moment. But do you think that actual infrastructure may not be used at all if Ramelius takes them and they're going to just send it all to Checkers and maybe expand Checkers to take everything instead of having Dalgaranga and Checkers?
Yeah, it could do. I kind of haven't worked through the full maths on where all that would go. I mean, having the mill right there at Dalgaranga is quite useful, and also having just the flexibility around having multiple mills in the region would help. Ramelius, I think if they're going to build Rebecca as well, they might need a mill there, so they could move some equipment down that way. I do think for Ramelius, it does make a lot of sense to have Spartan in their portfolio at some point. They've got 2 years left at Penny, which is really the cash cow over the next couple of years, and then that production profile starts to drop off from the back end of FY26. I don't know what the exploration upside is there, where that can be extended, but to have something like a Spartan plug in from FY27 on would, to me, looks like it make a lot of sense to combine those two. Obviously, at the right price and assuming a deal can happen there.
Given you're a generalist, Matt, I'd be keen to just pick your brain on the wider sort of things you're seeing in regards to labour inflation, cost inflation across the economy, and how this sort of plugs into resource projects, whether that be through mining services companies or just construction builds. What are you sort of seeing on that front?
Yeah, sure. So the labour pressures really have eased quite a lot. One of the things I do is actually track the mining services job ads for all the listed mining services players. I've been doing that for quite a few years now. That the job openings really did peak around early 2022 when the labour shortages were kind of the most acute. As we're coming out of the COVID period, there was a lot going on in lithium, iron ore, nickel, that kind of thing. And since that peak 2.5 years ago, we've actually seen the job openings fall about 40%. So that heat really has completely come out of the labour market. If you talk to the gold players, who generally are the marginal users of labour, like the gold companies get a bit squeezed in tight markets because iron ore companies, lithium companies offer much higher salaries, better working conditions, all that sort of stuff. There's much less of an issue in terms of staff turnover, absenteeism, that kind of thing. So I think from an Aussie perspective, we're starting to see some better results flow through. I think there's much better chance of guidance now being hit, costs coming in on budget, just given that labour and that productivity side's getting a lot better. And across the economy generally, we're seeing that too. I mean, the building construction side, you've had this huge pipeline of residential homes, which is now coming to an end, given home builder and things through COVID. So you're starting to see tradies and free up a little bit. Some of the areas that are still a bit tight around hospitals, aged care, childcare, it's moving in the right direction. So that side of things has eased. I think the labour pressures aren't really there anymore. I don't think it's going to necessarily translate into lower costs. You're still seeing wage pressure, wage rises going up 3-4% a year. That will flow through. I think where people will get the benefit is on productivity, less in terms of recruitment, less staff absenteeism, less turnover. That should really help across the mining sector and just industrials more broadly.
And, Matt, I'm kind of keen to peel into some of your energy stocks that you've got on the oil and gas side. There's two you flagged to us, Cooper Energy and Karoon.
Yep.
Karoon, screens sort of pretty absurdly, low multiple at the moment. There was a recent activist campaign to prevent, for them to introduce this capital management framework and pay dividends. It looks like their cash flow is going to be, quite attractive, but there's some doubt in the market that the board and management team are actually going to allocate that in a way that's best for shareholders. Do you take a view on the capital management of Karoon, or you basically just look at the value proposition, the cash flow, and look at the multiple and just think this is as good a place as any to allocate capital right now?
Yeah, that's the main thesis really, is just the cash flow that can be generated from these assets, provided they are producing at the rates they should. There's obviously been some challenges at both assets lately. I think, playing devil's advocate, one of the reasons for the acquisition of the US probably was to diversify away a bit from the Brazilian asset, given some reliability issues there, which probably weren't well known to the market, given it had a couple of good years of operations. The US being, relatively small in terms of value accretion and IRR, probably just goes to the fact that you're coming from Brazil, buying the Gulf of Mexico, you're going to have to pay more, and those assets trade on high multiples. So that was always kind of the valuation differential there, and why they were never going to get much accretion on that asset. When I look at the activist campaign, I kind of do agree with quite a lot of that. I think as shareholders, we do want to see capital management, especially given where the stock's trading now. If cash flow does what it should, it's on, like you say, absurd multiples in terms of free cash flow yields. I think a lot of that can be diverted to paying sustainable dividends to shareholders and potentially a share buyback. Certainly I'll be pushing the company to buy back shares rather than do any more M&A at these sort of levels. I do think, though, if they can, again, it's just about getting the operating rhythm, getting some good quarters out, showing the cash flow come through. The US had a bit of a false start, but a large part of the production downgrade there was actually on the gas side, just given the Henry Hub gas price had fallen so low. That's actually very low value in terms of the volume that comes out of that. So it wasn't actually it wasn't as bad as the headline read. US gas prices have recovered a fair bit since then, so we may actually see, top end of guidance or even an upgrade just with gas coming back in, which could be good for optics. And there has been a bit of exploration success and a couple more wells they're drilling now, which, if successful, just kind of adds to that growth profile over there and could turn sentiment a little bit. So it hasn't been an easy one. I do think they're good operators. I do think Julian's a very good CEO. Knows the regions very well. They've just had a few issues in terms of reliability and some other problems going on, but I don't think it's anything that can't be solved or turned around.
And then Cooper, different play. Is this like basically just the East Coast gas crisis? Here's the obvious beneficiary of that. Pretty much. The macro side on the East Coast gas market is pretty well known to people. I don't think I'd be telling you anything new there to say that there's a gas shortage coming up and spot prices are spiking in Victoria when the weather's cold and the wind doesn't blow. So that's all very supportive of the gas price over the medium term. I think what's happened on Cooper, again, this is a company I followed for a long time. We've only got involved in probably 6 to 12 months ago now that we've seen a lot of the negative catalysts come out of the way. The BMG decommissioning was a massive overhang on them. That's done, gone. Orbost, I think they've made some very good productivity improvements there coming from the COO they hired a year ago. That looks like it's operating more consistently at high rates. There's more they can put in the spot market. That is actually quite accretive to earnings there. So I think that Orbost asset, as that just operates more consistently over the next couple of years, you see the cash flow generation profile of the group. The way I view Cooper is they've got a fair bit of debt at the moment, but there's very minimal capex to spend over the next couple of years. If they do what they should do on cash flow, the debt gets fully repaid over the next 2 years. And you're then in a situation where they can start thinking about growth plans in the Otway Basin, where they've got an extremely underutilised plant. They've got resources in the basin there that are kind of ready to develop, and that could come to the mix kind of towards the back end of the decade. And I don't think that's being valued by the market at the moment. I think essentially what you're getting at 20 cents is current cash flows with a bit of a discount. Not assuming anything improves at all, boss, not assuming any of the growth projects work or have any value. And I think that'll probably be realised over the next couple of years. The one thing I would say, though, is oil and gas is becoming a big boys game. Like it is, the cost of rigs, the cost of developments is serious dollars now. We've seen with Cooper that BMG abandonment program blew out to, I think, $380 million at the end of it. And that's just to abandon a field that's not producing anymore. So I think at some point we need to see a bit of consolidation there. I wouldn't be surprised if that ends up as part of Beach or one of those other players down there. I just think oil and gas is becoming a real scale game.
Matt, given you're a generalist, how do you think about sizing all of these positions and sizing the energy component, the materials component, the mining services component as a portion of your portfolio?
Yeah, good question. So we generally own around 40 stocks in the fund. Position sizes, we don't go below kind of 1.5% positions. We just want to have a bit of conviction in things. And then the top end, some of the more stable industrial compounding type businesses can get up to 5-6% positions. What we do, our process comes down to a trade-off between what the upside is, what the quality of the company and the assets are, and the corporate governance, and then overlaying risk factors. So when we think about resources companies, the quality is generally quite poor. They're price takers. There's a lot of exogenous factors that can affect results that are completely out of their control. They've got limited lives, so they generally score pretty poorly on that quality filter. And then overlaying some of the risks, again, you've got commodity price, currency, weather, political risks, high capital spend, so score quite high on risk. So that generally means for us that resources companies are lower on the weights. We try to identify risks and quality up front and position size appropriately for that. Some of the biggest stocks in the fund are, an example would be a defensive tech company that grows earnings 15% a year and has a 10-year growth runway, structural growth driver where you've got a pretty narrow distribution of earnings. You can be pretty certain where they're going to come in and you can see them expanding into a bigger market over time. Whereas something like a gold company, gold price moving up a couple of $100 or down a couple of $100 really can blow out the earnings and the cash flow. And that's a struggle for us on earnings certainty because we really do value the earning streams of these companies more than anything.
Really interesting, mate. The I'll let you go, JD, because I was going to pivot to an overrated, underrated.
Get mining services in there.
Yeah.
Yeah. I mean, go for it. One of two of the names that you sent through, SRG, they do a lot of construction and sort of services work, and then PRN, a more kind of traditional mining services name. What's the thesis there?
Tell me how they fucking make money. Perenti specifically, and how you analyse it, because I do not understand it, especially when you're talking like the big quantums of debt that they hold and bloody low margins, and how do you get a bloody see the value in it?
No, great point. And look, I've been covering mining services stocks for kind of 16 years since I started the industry, and it's been a really tough bunch of companies to cover. Like every year something blows up on a contract, or there's too much debt, or the work dries up. So it's been this kind of death spiral for a lot of these companies over time. What's been the big change over the last few years, and I think COVID and labour shortages really drove this, was a lot of these companies seeing the value they actually provide to clients and actually starting to charge a bit more for that and get more favourable terms. So the pendulum's definitely swung back towards contractors. A lot of the contracts now are aligned style, cost plus type things. You're not taking big fixed cost risk or risk on items that are outside your control. So that risk of blowing up on projects kind of isn't there anymore for the most part. They've also seen investors want better returns. I mean, these things have been operating at 5-10% return on capital, which just isn't good enough for the amount of CapEx and debt they spend. You're seeing a lot of companies now moving towards 15 to 20% on the return side. So I think overall for mining services, that has been a big tailwind over the last couple of years. I think there's probably more of a re-rate in the sector to come as people just come back to the sector and see the quality of the earnings and the returns have actually improved, and they're a lot more disciplined on the capital side. The risk with that is there's not a huge amount of work around at the moment, so the contract news flow has dried up a bit. Does some of this pricing discipline start to dissipate and it gets more competitive, year-to-year returns? I think the other thing you've got to be aware of is mining services is just a cycle of the pendulum swings between the miners and the contractors, and at the moment we're heavily in favour of the contractors, but as soon as you start to have rental companies making 20% returns, contract miners making 20% returns, labour hire companies making those returns, by the time it gets to the miner, it's almost so expensive they just go, well, let's go back to doing it ourselves. So we're at a good point in the cycle now. I think there's still a bit more to go, but I'm getting a bit more wary on the medium term. Perenti is an interesting one. I mean, Barminco is by far the biggest driver in that business. They've been on the same journey as everyone else in terms of big CapEx, a lot of debt, a lot of new projects. They've really pulled back now to being more focused on returns, driving free cash flow through that business. The guidance they've got for FY24, which should see the results in a month or two, are for free cash flow to be $100 million. That's a 10% free cash flow yield, and then next year you could probably get 150 plus. Debt's really been managed down to a very appropriate gearing level, and I think we're at the point now where you actually need a bit of debt in these businesses to drive returns. So extra cash that comes out of these operations can be invested into good growth projects where they've got good tenure, with good clients, or we'll start to see capital returns. I think Perenti will probably reinstate a dividend. They've got a buyback ongoing, which there's more to do there. So that one kind of has flown under the radar a bit. You look at some of the other contract miners like NRW and Mans that have had big re-ratings. Perenti's kind of gone nowhere. I think the proof will be in free cash flow coming out, a couple of contract renewals which have been coming through, which are positive. I think the market's kind of missed that one, and that's probably a good pick for the next 6 months for us.
Yeah, I think, and like Barminco's the interesting one because you could see where they were heading in terms of trying to, as you said, partner with bigger companies probably on more favourable terms, like they've just extended. They've obviously got a good partnership with Regis. Yep. The IGO one's really fallen off a cliff with Cosmos getting canned, Nova's and Flying Fox and Nova and Forrestonia are finishing soon. So it's sort of opened them up a bit. You might get the double whammy if they're front runner for Spartan, so that'll bloody help things along. But have you got much insight into how those contracts are structured? Like, is there more less scheduler rates? Because I know they're one at Agnew with Goldfields. I think that was full scheduler rates. I'm not sure about the other ones if there's much cost plus coming in yet or not? You'd know more than me.
No, sorry. Yeah, on the contract mining side, it is more schedule of rates. My comment around the fixed price to cost plus is more in the construction jobs, which is the Perenti. So, yeah, sorry, I should clarify that. But I think in terms of their contract book, they've had some issues with nickel mines at IGO coming off, so that's been a bit of a headwind. There's been some renewals. There's some opportunity, I think, in Africa as well to grow in places like Botswana, even Tanzania, some of the East and West African countries. So there is a bit of growth potentially there, but I would view that as being a lower growth proposition for the next few years, but more of a capital return story. I think once the market starts seeing the cash flow generated there, that gets returned to shareholders in meaningful amounts. That probably drives a re-rate rather than, I'm not really expecting big earnings upgrades over the next few years for that one. They
make more money in Africa, a lot of those companies, than Australia. The DDH1 acquisition, that's probably I know it's probably not as big as Barminco, but it's still a pretty big arm now, considering DDH1 bought Swick before Perenti bought DDH1. How do you think that's going to be sort of value accretive eventually? Because I know there was some knocks on that takeover by a lot of holders.
Yeah, it was an interesting one. I mean, the market probably hasn't had a favourable view of drilling companies for quite a while now. A lot of the listed drilling companies have had issues over the years. It's super cyclical and it's provided a lot of challenges. So the market wasn't that positive on that one. I do think it makes sense over time. I mean, they did have a small Ausdrill kind of fleet there, which there are some synergies and some costs they can take out. It gives them an operating base to utilise tax losses in Australia as well. So from a purely financial sense, they've got a lot of tax losses in the Perenti Group in Australia, bringing on a big Aussie earnings base, and DDH can utilise that and get some better cash flow in. The timing probably wasn't ideal. We have seen exploration tick down. So I think there's that exploration side of it's probably struggling a bit. I would probably say that, I wouldn't be surprised if that underperforms the acquisition case. But having Swick there, having some of the iron ore business, I think it's called Ranger, which is a bit more stable in terms of production drilling, that's a pretty good base, that business. And if and when the exploration cycle resumes, there's quite a lot of leverage there on the upside. And when that'll be, I don't know. I'd be kind of surprised how weak exploration spending and junior capital raisings have been, given the Aussie gold price is at $3,500. But you have to think at some point the rigs start turning again, and DDH will be one of the beneficiaries.
Can they definitely use the tax losses of Barminco with the entity they bring in?
Yeah, my understanding is they can. Yeah.
Okay. Yeah. Interesting.
Matt, you ready for overrated, underrated?
Oh, here we go.
Let's do it. All right. We'll we've JD and I have beefed out a big list here, so I reckon we'll go with the succinct version. But if if any of us are just want you to elaborate why, we'll ask why. Or if you feel the need to give a one sentence of why, then please chuck it in there as well.
Sure.
Alrighty. Overrated, underrated. Matt Griffin, you ready? Owning physical uranium or gold bars instead of the miners.
Look, given I run an equity fund, I'd have to say that's overrated. To be honest, it's been the better strategy over the last probably couple of decades, but I do think we're at a point now where you get more leverage out of the equities and there's big valuation disparities there.
Yeah.
Participating in IPOs for mining companies?
Probably overrated. We don't really do many IPOs in general. I haven't. Yeah, a lot of the mining companies at least are kind of exploration size, a bit too small for us anyway, so there's not a huge pipeline there for us.
Passive investing's distortion on financial markets.
Look, I think that's probably fairly rated. I think there is a fair bit of distortion there. I think it probably does get overplayed a little bit. But in terms of active management, if there is distortion from passive, it should be great for us because it just means there's more opportunities that aren't being picked up. So potentially a positive tailwind.
African risk as a sort of broader jurisdiction?
I think it's overrated, as I said before. I think a lot of these African risks are kind of overstated, especially in the gold space. I just don't see too many impacts to gold mines over time.
Iron ore staying above $100 US a ton for the next 24 months.
Yeah, interesting one. And I know you guys did the thing at the end of last year where everyone's bearish pick for the year was iron ore and it's still over $100. Look, I don't know an iron ore. again, we're not macro guys. It's hard to make a call. I've been probably a bit surprised it's held up so well, but given how weak China's been, if China does turn the corner and start to get more positive, you have to say it probably does hold up at these levels. So maybe that's underrated, I guess.
The influence of the recent Aussie government funding on critical minerals and downstream processing and whatnot.
Yeah, I think that's overrated. My quick view on that is I think the government's probably going to lose a lot of money on this stuff. You know, there's always money around for good projects, and a lot of these projects that need government funding need it for a reason, because equity markets and debt markets aren't willing to fund it. I don't really get the whole point of building out all this critical infrastructure in Australia, or parts of the supply chain and not the full thing, without the operating base here. So overrated for me.
Short selling.
I think that's fairly right. I think shorters have a place. We're long only. I think shorting's very hard. It's probably not something I can do successfully, but I've got no issues with short sellers. I've got no issues with people taking different views to me. The debate's healthy. I think it leads to good markets.
We've never met a short seller in Australia.
No, they don't exist. Yeah.
None of them. Everyone's long only, apparently, on the show anyway. We believe you, but Matty.
Yeah.
Similar to the iron ore question, what's your view on 6% spod being under or over $1,500 US a ton in, let's say, in 2 years' time?
Ooh.
Yeah, look, I'm firmly coming to the view that lithium's going to be challenged for a while, so I think it'll be under. The views are based on a couple of things. I just think hybrids are taking over from full electric vehicles, and there's much less lithium needed. I don't think some of those Chinese supply sources like Africa or the lepidolites really turn off necessarily where people think they do either. So I do think in 2 years we probably have a pretty tough market for lithium.
Buying instead of building.
Yeah, I think that's underrated in terms of, I think buying over building is the better strategy at the moment. If you look at building, it is getting a lot harder. Permitting, native title, environmental, those timelines are just massively blowing out. So the value in having existing infrastructure there is huge. I think that goes to the Spartan point as well. And you look at some of these projects like McPhillamys from Regis, which has just been caught up in permitting for so long, it's kind of destroyed the project. Like, they built it when they thought they would be making really good money now, but we're now at a point where the economics are challenged just because it's taken so long. The permitting and the construction side's really blown out, so a bit hard.
How about going on site visits?
Oh, underrated. I try to go to as many site visits as I can. I think there's a huge amount of value in getting out there, seeing things firsthand, getting a sense of the people on site, you know, the next layer of management down, what sort of people are, what their incentives are. I think it's time very well spent.
Is it sometimes detrimental and clouds your judgment when you get the fluff fest up there?
Yeah, but you get that meeting management in an office anyway. Yeah. You know, you've got to take everything with a bit of a grain of salt in this industry. One of the things we do is just consistently meet people over time, go to sites over time. You build up a track record of knowing people, knowing who you can trust, who's conservative, who's aggressive. And I don't think you get that from one site visit or one meeting. I think that's really something you've got to build up over time.
Regis.
Ooh.
Regis Resources, I would say probably overrated. I just see a bit of a challenge in terms of Duketon ending. I think they've probably got to acquire something, given McPhillamys looks a bit tough. So, look, nothing against the team or the company. I just think there's better opportunities in gold at the moment. And
the royalty claim.
Oh, yeah, that's hanging over too. Who knows where that goes? That's really interesting, the history on that one.
How about Sandfire?
Sandfire's probably overrated just on valuation. I think I really like what Brendan and the team have done with that company. I think they've got the operations humming. Bringing on that Matheo project and ramping it up has gone really well. I struggle to see what the next leg of growth is post FY25. So there's maybe some more M&A that has to happen there, or some other projects that come in. But I just think on a valuation perspective, we prefer metals acquisition.
Vibe investing.
Vibe.
Yeah.
Yeah, look, I mean, it probably has its place for people. For us, we're very fundamental, bottom up. I enjoy doing the models. I enjoy talking to people getting as much information as I can. Sometimes you do have to get a vibe on things, positive or negative, but 99% of what we do is hopefully backed up by facts and information. Although it does reach a point where, the sort of rule I think we operate on is if you think you've got about 70 or 80% of what you need to know, that's enough to invest. Doing that extra 10 to 20% of work does take a long time, is pretty hard, and you do miss out on opportunities. So you can get a bit of a vibe in there as well.
Mate, Griffo, if you ever need a vibe, mate, I'll let you know what the vibes are, because I'm all vibe. 100% vibe here.
How about in a similar sort of vein of thought, FinTwit? Are you a user?
I'm not, but one of the other guys in the team is, so I get it all of him. I try to steer clear, but I'd rather read like quarterly reports and annual reports and other things. But one of the guys in the team loves it, so he's on top of that and he takes care of that for us.
Capstone copper.
Look, I think, probably overrated again compared to Mac. I haven't done a huge amount of work on them. From a cursory glance, it's big, it's copper, it's got growth, it ticks all the boxes. There have been a few guidance misses over the last few years, and I'm just a bit worried about the track record on a few of the assets, and especially given there's a ramp-up phase coming on a couple there, so that could present a few challenges. And it does screen as reasonably expensive as well, so not one for us at the moment, but one that might look interesting at some point.
How about Mader?
Ooh.
Yeah, Mader's done an incredible job. It's hard to say at the moment. I mean, it's been such a good growth story. There's such a strong pipeline of geographies, different parts of business they can go into. My concern in the short term there is just around this labour shortage easing and what that means. I mean, they've really been a big beneficiary of that. I think if they can get through the next 12 months and continue this growth profile, then that's set. The business works. There's no doubts in it. So I think this is a pretty critical period coming up. There are a few competitors trying to start up, small internal type Mader divisions, which might eat away at them a bit. And then it's just a question of, do the miners start to see labour more freely available, so use more of their own labour compared to using Mader a bit more. So it's going to be a very interesting 6 to 12 months ahead for them. I think that's really going to make or break the model and whether it can keep trading on the multiples it does.
Ionic clay rare earth deposits out of Brazil.
Yeah, interesting. Look, a lot of those are kind of early stage for us. So I've met with most of them. I haven't done a huge amount of work. If they work, it's probably very bearish for anyone that's not an ionic clay Brazilian rare earth producer, because there's so much potential supply at such a low cost to come out of there that it might just suppress the price and destroy a lot of the hard rock projects. Obviously, they face challenges in terms of permitting, ramping up, CapEx. Rare earths is not easy in terms of getting the processing, all the downstream right. So depending how far they want to go on that track, could be a bit hard. I'd probably say fairly rated. The risks are probably evenly balanced at the moment.
What about the payability of those rare earths by China?
Yeah, that's another question. I mean, recoveries, payabilities, it's quite an opaque market, rare earths. It's been quite difficult from an investment perspective. We have not held anything in space for quite a while. It's just too many questions too opaque for us, that whole space.
Nickel mines.
Interesting. Look, I'm probably pretty bearish on the nickel price. I just think the whole trend towards LFP batteries has taken a bit away from the nickel growth story, as well as probably the more bearish view on battery sizes with plugins. Nickel mines is interesting because they do own the resource, and I think that's becoming an increasingly valuable asset, because a lot of the stuff we're hearing out of Indonesia is that they're going to be resource constrained. So that becomes probably more valuable than what the market gives them credit for. There's a lot of risk there in terms of Chinese ownership being in Indonesia. Just becomes a bit too hard for us at the moment.
AIC Mines.
Yeah, haven't looked into too much detail. It's one I probably need to do a bit of work on. I've heard good things about management and the operations. Potentially one of those next tier of juniors to come through in the copper space. The junior copper market has been tough. Like, those small scale producers have tended not to make any money, even in good copper prices. So I'd have to check on their plans, but I think you need a bit of scale in that space to make money. But too early for me to make a call on it. I need to do a bit of work on that one.
Last one from me. BHP's big bet on potash.
Yeah. Look, I don't know the first thing about phosphate and potash, to be honest. I followed potash loosely when, a few junior companies have potash assets over the years. Again, that's a big boys game. It's a tough market to understand. Can't help you there, sorry.
Metals X.
Yeah, we've got a good history with Metals X. Actually, I've been down to Renison in the past. It's a great mine if you ever get a chance to go down there. We did make a lot of money back on it probably 5 or 6 years ago. We've missed it this time, just given the company's had probably some operational hiccups, which has meant we've kind of steered clear. Haven't had a big view on tin really, but could be interesting. Yeah, I think that's probably underrated.
Bloody beautiful.
Awesome. This is wicked, mate. Thanks for chatting with us.
That was right in our wheelhouse. Loved it.
I'm always so impressed by the generalist investors that can talk in great detail across so many different sectors. So thanks for making the time and chatting with us, Matt.
No worries. Thanks, guys. Great to be on the show. Appreciate it.
You beauty. That was a fucking brilliant chat. Oh, I love talking. I say it every time we talk about this sort of stuff. I love talking about shit I know a bit about. I'll repeat myself. That was what a bloody GC.
Awesome.
That was great. Couple of partners to thank, eh?
Yeah, mate, at the bloody top of the show, our great friends at Axis Mining Tech. Look at the great hat that Trav's got on. And who else we have in the show? A bit of K-Drill, going to go bloody power the Leonora and Laverton region. And DSI keeping Cobar alive and the rest of the world. Also got CRE Insurance, WA Waterbores, Get Wet Solutions.
Verify.
Mineral
Mining Services, Silverstone, CRE Insurance, WA Waterbores, mate, and use a spark chart. Get a spark chart.
Let's just mention them all twice.
We'll say a few times.
Oh, how good Spark, and how good is JD and Trav? Hoodaroo.
Go Australia.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.